Hello, good afternoon. Hello. Thank you very much. We're going to get going now on our afternoon session. If I could ask everybody to please take their seat. Vishnu, you're in charge of the back down there. Keep it quiet. Get him to sit down. Thank you very much. We're going to move on to our afternoon session now. We appreciate your patience. We had a couple of technical difficulties with some of the sticks here, but I think we're good to go now. Our next session, I want to do an introduction here. Is innovation finance as a market transformation strategy. So, obviously, innovative financing structures to distributed energy are a very, very good tools. One of the first coachings I ever put in was done with a creative finance structure. So they're very valuable tools in a lot of cases. I want to introduce the moderator for this, which is Kenneth Berlin. He is Executive Vice President for the Coalition for Green Capital, and he's going to moderate and take this session forward. And with that, without further ado, Kenneth.
Well, thank you. It's a pleasure being here today. The session right now is on finance, and I think finance is a critical subject in the area we're talking about now, because we need in the United States a financial system that provides abundant financing for clean energy projects, energy efficiency projects, distributed energy projects, at a price and at a rate that is reasonable and works well within the system. So when we began work at the Coalition for Green Capital, where I'm working, we started by asking ourselves a number of questions that really relate to how well is the commercial system working. Now, on one level, of course, it works very, very well. I mean, we've probably got the best commercial system in the world. We can finance lots of projects out there, but in the end, we need to finance, if we're going to really transition to a clean energy economy, we're going to need trillions of dollars in the system. We're going to have to get it out into all kinds of projects. So we asked ourselves a bunch of questions relating to that. The first is, was the system itself generating enough funds for the projects? Even if the money's out there in the system, the money that commercial banks have can go for other uses also. Was it generating enough funds, or was there need for some sort of supplemental funding, even on the debt side, not just on the tax incentive side, to get the projects done that we need to get done? The second question we asked ourselves is there a need in some situations for low-cost financing, a little bit lower than commercial rates, so that we can lower the cost of projects further, so that more projects can be built. The projects can generate electricity at a rate of return somewhat competitive with the rate of return out there, and still provide an adequate rate of return to the investors. These projects won't happen. If you have renewable portfolio systems, you might have more expensive projects built, but eventually you start running into all kinds of political problems when you start getting to scale, if you're really significantly raising the cost of projects. So was there a need for low-cost financing? Were there gaps in the financing? Were there market failures that really justified some other measures to supplement the commercial banking system? For example, we did a study in New York on a New York Green Bank that was set up, which I'll talk about in a minute, which identified in that study, based on interviewing people in the industry, a whole set of issues that we thought needed to be addressed, including funding for small projects, difficult for a lot of commercial banks to do, providing the needed liquidity in the market by securitizing a lot of the notes out there. Then we asked the question, is there some advantage for the government to give loans instead of grants on projects out there? And a lot of the work we've recommended is a repurposing, in some cases, not all cases, of loans into grants. Now, to do that, you've got to reach a conclusion that you get a better result from loans. In other words, we can give the loans come back to the government so they can be used over and over again to let us get to scale. But can we give the loans at a rate that people can still do the project developers, and still make an adequate profit, because they have to repay the loans, but they wouldn't repay the grant. And by adequate profit, we mean a profit that's acceptable to the industry, not one that we are looking at. Others have looked at this, and it's not an exhaustive list of questions, said, well, not just the government here, what can we do in private industry? Can we develop different ways of doing this in private industry in different structures than commercial banking to make these loans work better. Now, and I'll get back to that in a second. So I started working on these green banks 3 or 4 years ago. We began in 2009 and 10 on the federal level. In the Waxman-Markey climate change bill, we had $7.5 billion of seed capital for a national green bank. In the Senate energy bill, we had $10 billion of seed capital. These bills passed where they were, but obviously the climate change bills on an overall basis did not pass. We then turned to the state level, and we now have 4 state green banks set up, 3 that we worked on in Connecticut, New York, and Hawaii. There's one, essentially a green bank, I think, in Vermont, which we were not involved with. I'm working in lots of other states. So we have some experience with this. We, in particular, have paid attention to the issue of how do we do this without crowding out private banking investment? How do we do this as a supplement? Because our goal is more investment, not less. If we just replace private investment, we really wouldn't be accomplishing anything in doing this. So we've looked at that. Now, as the moderator, I don't have to answer all these questions. I can turn it over to our panelists. So we've got 3 panelists today. One who will talk about this from the standpoint of green banks. The other 2 will talk about it from the standpoint of private investment in this field and innovative investment in this field. Our first speaker on this is Alex Craigie. Alex is a former colleague of mine at the Coalition for Green Capital. We worked together on the Connecticut Green Bank, and then Alex stayed up in Connecticut. He is now the Deputy Chief of Staff to Dan Esty, the Commissioner of the Department of Energy and Environmental Protection in Connecticut. And with that, let me turn it over to Alex.
Thank you, Ken. Good afternoon, folks. Thank you for having me here today. Special thanks to Bill Pentland for bringing me out here, and for Ken for moderating our panel. Pull up my presentation right here. What I'm going to do is I want to talk a little bit about the bigger picture of what we're trying to accomplish with this green bank movement, if you will. And I also am excited to hear my colleagues from the private sector speak about their viewpoints, and everybody always has different ways of looking at it, so I'm looking forward to an engaging and spirited debate over the future of this movement, if you will. But as like I said, I'm going to say some big picture words and then talk a little bit about what our green bank in the state of Connecticut is doing, what it's accomplished, and where we plan to go forward from there. Excuse me, sorry, I'm slideshow. Get this fired up. So the idea of using innovative financing tools to drive the deployment of distributed generation has its roots in 2 tectonic shifts in massive segments of the American economy: the energy industry and the financial industry. In the energy sector, there's been an emerging sentiment that the climate is changing, that the reasons for the change are very likely man-made, and that the way we generate our electricity plays a part in that change. Now, it can't be said these sentiments can be proven to 100% certainty at this point. But as my friend Ken likes to say, if you go to 39 doctors and they tell you you're in terrible shape and you need to start watching your diet and eating better and living a healthier lifestyle, and you go to one doctor and he says, no, you're good, you're fine, don't worry about it, you're probably going to want to listen to the 39 doctors. There's near consensus there, and even though there may be a couple minority reports, there's good reason for moving forward on the plan recommended by those 39 different doctors. Now, as the sentiment on climate began to evolve, our domestic and international markets fell into turmoil, and as a result, our nation's economy was staggered. The resulting squeeze of finances permeated every single aspect of American life, from federal government to the family budget. State and municipal budgets were especially hard hit, a blow which could have been really truly fatal without the stimulus package passed in 2009, put in place in 2009. The confluence of these 2 shifts, of the energy and the financial markets, resulted in a new political imperative among policymakers. Leaders had to find a way to do more with less. This is the origin of what might be termed the Green Bank School of Thought on Policy, which is now starting to take thought, beginning in the Northeast, the specific tools to deploy to meet every challenge will vary from state to state and from institution to institution. But the core principle is ensuring that taxpayers and ratepayers are getting more bang for their buck. We want to make each dollar work a little bit harder. The question is, in a time of small budgets and large to-do lists, how do leaders like my governor, Governor Dan Malloy in Connecticut, or Governor Andrew Cuomo in New York, how do these leaders extract more value out of every public dollar spent? Well, innovative policy that utilizes creative financing, among other tools, is being proven as the best way to meet this challenge. Now, I'd like to take a little bit of time to walk you through what it is we're doing in Connecticut and why I'm here today to have this discussion. So our green bank model for energy in Connecticut is more than just what Ken is referring to as a green bank, and we call it our Clean Energy Finance and Investment Authority, CEFIA. The acronym's tough, but the work is good. Now, what we're trying to do in Connecticut is move away from the subsidy structure to a finance model, using our very limited government resources to leverage private capital as best we can with our minimal public dollars. We're trying to drive every kind of energy efficiency that we can possibly find in state government. We have our Lead by Example program in the private sector, in the commercial, industrial, and residential sectors. We really are trying to go a little bit further than typically has been gone with energy efficiency measures. So instead of what's called light efficiency, literally going around and swapping out lights, putting in weather stripping, we want to go deeper into the guts of the building. We want to really get into it and drive projects that are capturing those energy savings that might otherwise go uncaptured. We want to move towards deployment at scale to lower costs, and we have found success in this in Connecticut at tackling this challenge. When Governor Malloy came to office in 2011, the previous year, 2010, the state of Connecticut had deployed 5 megawatts of clean distributed generation onto its grid. In 2013, this year, we're going to be putting north of 55 megawatts. You've seen an order of magnitude ramp up in terms of deployment of what's been able to get out onto the grid, and I expect that trend to continue going forward. And we also want to be in a position where we're not picking winners and losers, where we let the market tell us who the winners and losers are. And that's one of our core guiding principles. This is the strategic goals for our CEFIA, or our Green Bank. The big driving core principle is that our institution is in charge of attracting and deploying capital to finance the clean energy goals for the state of Connecticut as put forward by Governor Malloy. And we've met with some success in doing so already. You can see the subtext here, but I won't get into it. Here's a little bit of background on the organization itself. We want to move away from grants and rebates and into programs that drive private capital into the marketplace. So to put it very simply, we want to move away from projects where CEFIA is putting up $1 and the private developer or the private entities involved in the project are putting up $1. And we want CEFIA to put up $1 and we want to see $10 in return. We want to see our leverage ratio skyrocket, and we have seen that in the past couple of years in terms of the investments that we are making. The proof is in the pudding. We already have returning some results. Our organization is 2 years old, but this year we've put in we've driven over $200 million of investment using $20 million of CEFIA funds and getting out 30 megawatts through CEFIA alone in the first year of our Green Bank program. So this approach is bearing fruit already. This is a pretty simplistic chart here, but it really does show you the kind of impact that we can have. Now this is not just CEFIA, but in the entire clean energy industry in Connecticut, we have looked at a massive influx of employers into the state. And that's been something that for me has been particularly exciting to see. And I know for our governor, Governor Malloy, who has made very clear that his laser-sharp focus on job growth and creation in the state is a major driver of every policy that he puts forward, energy and otherwise. New York, as Ken referred to, created what we like to call in Connecticut the nation's second green bank. It's capitalized at $1 billion, which is a little bit more than we're working with in Connecticut. We roughly have a $30 million coming in every year, so Governor Cuomo had to come in and throw $1 billion at it. But we're very pleased. This is a very encouraging step that's being taken, And our friend Richard Kaufman is in charge of energy for the state of New York, and he has been very, very closely involved in the crafting of this entity, and will be involved in its programs moving forward. So we're thrilled that our friend Richard is engaged in that and leading the charge in New York, and throwing a heck of a lot more money at it than we are, but they got a little bit more to work with. So what has been done? What has put forward? How have we gotten to these numbers? What this chart essentially shows you is that we're hitting all of our targets. We are driving down the ratio of ratepayer to private capital. We're ramping up the installations, and we're seeing costs fall for the overall price of the projects that are getting installed in Connecticut. So you can see the trend as it moves forward there, 2004 through 2013. We have programs, Solarize Connecticut program, which many folks might have heard of. It's essentially an aggregation program that brings together demand and packages it and allows for companies to get even lower, offer even lower prices thanks to that demand aggregation. We have the Bridgeport Fuel Cell Park that was financed in part with CEFIA loan that was given an award earlier, which was very exciting. And we have the Connecticut Solar Lease Program, which is a program that involves $10 million worth of Connecticut ratepayer money and private banks putting forward in excess of $50 million of their capital to go through this solar lease program. We also have a Smart E loan program that we're working on, and this is going to be for natural gas expansion, so for residences that are interested in natural gas conversions, for businesses that are interested in natural gas conversions, and for anybody who's interested in energy efficiency or clean energy upgrade. And so we're collaborating with capital providers on the local level, as you can see in the slide here. And PACE, we're the first state in the country with a commercial property assessed clean energy program that is in place, and it is working. We're driving, I probably don't have to explain the concept to folks here, but we are driving investment by utilizing that senior lien approach, and we've put tens of millions of dollars into the marketplace in Connecticut through this program, and we think we're just getting started. We know we're just getting started. This is all the different municipalities that are participating in the PACE program. I won't belabor that for you. And here's just a case study of a PACE project, a CPACE project that we have already gotten underway. There are many, many more where that came from, but this gives you a sense of the very small investment that is required on the part of the state, so we put very few taxpayer and ratepayer dollars at risk, and the very large return that is achieved to both energy savings and to the investors of the particular project. So I don't want to drone on. I think the majority of the interesting part of this conversation is going to be when we're taking questions and answers from the audience and speaking amongst ourselves. So I will end it with that, and thank you all very much for having me. It's a treat to speak to you, and if you have any questions, I usually put my contact info up, but my email address is alex, A-L-E-X, .craigie, K-R-A-G-I-E, @ct.gov. And if you reach out to me, I'd be happy to speak to you. We're eager to have your business in the state of Connecticut and keep your business in the state of Connecticut. So thank you very much, and I'll talk to you soon.
Thank you, Alex. Our next speaker is Jeffrey Eckel. Jeffrey is really one of the leaders in the country, if not the leader in the country, on doing innovative financing in the energy field in the private sector. He's the president and CEO of Hannon Armstrong Sustainable Infrastructure. He's also chairman of the board of the Maryland Clean Energy Center. And with that, have Jeff come up.
Interesting on this Green Bank thing and who's number one and who's number two. We'll have to talk about Maryland Clean Energy Center another day. But delighted to be here and talking about cogeneration. There we go. As I'll show, this has been a technology that I've been involved with in my entire career and really very much appreciate it. So thank you for the WADE organization to invite us to speak. I'm CEO of Hannon Armstrong. We went public in April of this year, so I have to have a slide like this that nobody can read, but there are risks in investing. So the question I would ask is, has cogeneration's time finally come? And forgive me, this slide's a little bit self-indulgent since I've been doing this a very long time. And I was thinking yesterday when I was putting it together how stunningly long I've been doing it. The first deal I ever did was in 1985. It was a 25-megawatt bottoming cycle cogeneration plant for the Department of Energy. Hannon Armstrong did the transaction. I needed the commission in the worst way. I just had a baby, and it was very important it got done. That's why it was such a soft spot for cogeneration. But it was also the first third-party finance transaction in the federal government. I was a young man, testified to Congress in '87 about how they could expand the program. I thought it was going to take off. By 1989, I still hadn't done another deal. It takes a while in the U.S. government. Wait, hang on. I was recruited by the founder of Wärtsilä Power, Wärtsilä at the time, power plant business, a guy named Kasse Strand, and Wayne Elmore, I'm not sure where you are, but hi again. Was recruited to be the CFO of Wärtsilä North America to go after a power plant business using Wärtsilä's historic marine engine product line. So I thought it would be terrific. I'd go to Europe once a year, and it'd be neat. First week I was in the Dominican Republic. Second week I was in the Dominican Republic. 37 trips to the Dominican Republic. We sold a lot of power plants. Some of them, however, didn't get sold the right way. Financing problems came up, also in the Dominican Republic. And we formed Wärtsilä Power Development to own, develop, and finance and operate power plants. And in the 4 years I ran that business, we did 750 megawatts. There was a couple projects that had a cogeneration aspect. Mostly they were heavy fuel oil projects everywhere from Honduras to Pakistan to Vietnam and China and, of course, the Dominican Republic. But I fell in love with engines and understand the efficiency and the power in the diesel engine cycle. I was recruited by Bechtel to start a company called Energy Works. It really could have been a good idea. It wasn't, but it could have been. We were going to do small-scale distributed generation, basically bring first-world power quality to U.S. and European manufacturers operating in India, Indonesia, and Brazil. Energy Works do Brazil still exists. It's owned by Iberdrola. We did a number of cogeneration projects. The first one was using the 32 gas engine for a brewery in the north of Brazil. We did a number of gas turbine projects using primarily the solar turbines and a number of other engine and turbine projects. What we really did, though, is figured out how to aggregate small $5, $10, $15 million cogeneration projects into a standardized financing package that allowed our sales guys to go sell something we knew we could finance. So that was my first foray into securitization. It was very successful. There were a couple of things going wrong in the world economy in the late 90s that made the business a little challenging. But the finance technique, I think, is still quite relevant to today's discussion. I went back to Hannon Armstrong in 1999, and we created a securitization vehicle that built upon the Energy Works securitization vehicle. It was called a Hanny May, Hannon Armstrong Multi-Asset Infrastructure Trust. We aspired to do $150 million of transactions, average size about $3 million. It has been very successful. We've done over $3 billion of energy efficiency, distributed generation, and there's about 350 million of cogeneration facilities in the Hannon Armstrong portfolio. The ability to standardize the financing, to get it done on commercial terms, and to have the certainty of execution and closing. Having been a developer, that's what I always wanted. I always wanted to know what the contract needed to look like, not pretty much what it needed to look like, exactly what it needed to look like, because the developer of a cogen plant, I think, has a much tougher job than the financier of a cogeneration plant. And we want to make that job as simple as possible through standardization. We've had a very good run with a Handy-Made product and Hannon Armstrong, but we did come to the conclusion that climate change is the defining issue of our generation and my children's generation. And while we're very proud of doing $3 billion, it's a drop in the bucket. So we made a tax election to convert to a real estate investment trust. It's a very investor-friendly structure. You get a 1099, not a K1. We listed on the New York Stock Exchange in April and raised $165 million. We've levered that up with $700 million of credit facilities and are starting to fund cogeneration projects, energy efficiency projects, but now as a REIT. A lot of cogeneration projects really can be considered a building system, really can be considered a real estate asset, and we'd love to own them. So that's my self-indulgent review of my view on cogeneration finance. But I really do think small-ish assets need tailored financings, and we think the REIT structure may be a key, certainly not the key, but it's a key to unlocking the massive amounts of financing that is potentially needed for a scalable cogeneration business. In terms of what we do clean energy, energy efficiency, and other sustainable infrastructure. Cogeneration, wind, solar, geothermal. We would do a biomass project. We would do waste to energy. They're obviously much tougher transactions. I've already mentioned the energy efficiency. We've got assets under management of $1.9 billion. The specialties are really distributed generation and vendor finance. So when I see Caterpillar and Wärtsilä, these are companies that I really value what they do in the market. Markets, we perceive the college and university market to be a very near-term market for a lot of the vendors, for a lot of the developers. If it starts to look like a microgrid with engines and turbines and PV, terrific. U.S. federal government has been our core. We'll never leave it. What we are now seeing is the, not just post-Sandy, but post 9/11, the hardening of the energy security on a military base is very key. We've done a $100 million microgrid at the Food and Drug Administration. It looks a little bit like a distributed generation equipment catalog. It's got a Wärtsilä 34. It's got some CAT engines. It's got some solar turbines. It's got some PV, all combined together for a very robust power system. In the state and local government market, we're very active in it, but not in the traditional tax-exempt lease. We've developed a product that is off credit. Moody's and S&P gives the agency a pass on calling our debt a credit facility, and it increases the bonding capacity. We think that's very applicable for the kinds of transactions that this audience might want to do. From an investment style, we hold on the balance sheet, we syndicate, and we securitize. Really, that doesn't matter. We have capital. How we finance ourselves is sort of our team's problem. Our target size is, for an individual transaction, we'd love to see it be 15 to 50 million. We'll certainly go smaller. For a vendor client, we'll do any deal that you want to do as long as there's a lot of them. Again, we understand the difficulty in your business. And in terms of the slice of capital, we can do equity. We prefer senior debt. We actually think senior debt is the harder piece to do. And we'll also do holdco loans, which is perhaps more applicable to the solar business. Okay. So I participated in my very first sustainable SRI investor conference. Maybe since I don't know what the acronym stands for, that's why I don't get invited very often. But socially responsible investing. When I talk to REIT investors about what we do, there's zero industry context. They don't understand that the fact that utility kilowatt-hour sales are flat or declining has something to do with the people in this audience and the financing we provide. When I talk to the utility investors, they get it. The SRI investors really got the environmental theme, but I think we got credit for being a little bit more rigorous in. Oh wait, I'm on the wrong slide. No, I'm not. Focused on the fact that we're paying a dividend and we're doing sustainability analysis in a very rigorous way. So we've announced a Q3 dividend of 14 cents a share. On our IPO price, that's a 4.5% yield. We've targeted a 7% yield on our Q4, again on the IPO price. We will be growing the dividend 13 to 15% as capital is deployed, and distribute, as most REITs do, substantially all of our net income. We think the yield is attractively priced to other MLPs, infrastructure funds, or yieldcos. So far, investors haven't quite bought that, but we'll get there. The focus on credit is we want to maintain an investment-grade portfolio. We can do transactions that are below investment grade. We just want to score out to triple B minus or better. We really like transactions that are economic without subsidy. We're not Pollyannish. We will take advantage of subsidies. But in terms of sustainable types of capital that can get done, I think we just have to find the things that are economic. We really like essential infrastructure, not fashionable kinds of assets. And our sustainable definition is neutral to negative on CO2. And that's where we have developed a thing called Shades of Green. I got asked by Kevin Walsh a lot of times, who GE Energy Financial Services, why do you guys focus on energy efficiency and geothermal and cogen? They're so hard. And I have this theory that capital is scarce. I'm continually reminded of that with our investors, and that carbon counts. And what we really should be focusing on are the transactions that are most impactful on CO2 reductions. So again, this is where the SRI group was quite empathetic with our story. And what we do and have done for over a decade is track metric tons of greenhouse gas per dollar invested, just to make sure we're doing impactful things. All things being equal, we'd rather do an energy efficiency or a cogeneration project or geothermal project than a residential rooftop solar project. That doesn't mean we don't do rooftop solar. It's all good. But again, if capital is scarce, we want to be as impactful as we can with the limited resources we have. And that's our tagline, sustainable yield. So I'm selling that one door to door. I thank you for your attention and look forward to, and I want to introduce my colleague, Bob Johnson. There's Bob. So thanks so much.
Thank you, Jeff. Our last speaker is Doug Beebe. Doug is the Vice President for Energy and Finance at Key Equipment Finance, a subsidiary of Key Corporation, which is among the largest well-capitalized banks in the United States. So I think we can talk about this from a slightly different angle. Thanks.
Thank you. I don't have any slides here, so I'll just talk. And I think we'll eventually have some question and answer and have a hopefully engaging, lively conversation. But as you said, I'm Doug Beebe. I'm the Vice President of Energy Finance for Key Equipment Finance. We're part of Key Bank, which is a publicly traded bank, $89 billion in assets, which makes us probably 19th or 20th largest bank in the country. And these days, I don't know if you want to be the largest bank. If you look at the headlines these days, you don't necessarily want to be in that spotlight. So we're large enough to have a low cost of capital, be competitive, but not big enough to be too difficult to navigate. So we're very smaller, friendly organization. We've been in the energy business for a long time. Ever since 1996, we've had an energy practice within Key Bank. We've done over 80 wind and solar transactions, and along with some CHP, some cogen, working on some landfill gas right now. My particular part of the group offers a leasing solution. We've done decades of leasing, and all we did was take our leasing practice and convert it into the energy business for any energy asset. And essentially, we're offering just a couple different types of leases. We offer an operating lease or a capital lease, and then we can combine those two to offer synthetic lease. But we are offering a leasing solution to simplify things. And what that lease is, it's a direct, full recourse lease, which means somebody's on the hook for a fixed obligation, hell or high water payment for that generating asset, regardless of if the system works. So, but in return for that, what they get is they get 100% financing on the project, hard and soft costs. And you get streamlined documentation. We take our basic lease agreement and apply that to the energy transaction. So our primary focus is commercial industrial. We've done some university, we've done some municipality, some other nonprofits, but that's our primary focus is commercial industrial, and it's all primarily distributed generation. That's where we've seen the most effective use of our capital, and I think the most demand right now. I think everybody in this room understands that's where the growth and demand is going to be. In addition to that, we offer construction finance. So during the construction period, we provide progress payments, 4 or 5 payments to the EPC, who in turn pays the vendor, and then at the end, we convert that into the permanent lease. And our terms, anywhere from 7 to 10 years, and we'll do small transactions. Because we've got a lessee on the hook for the payment, we'll do anything $250,000, which is small, but we've done small solar rooftop transactions all the way up to large 16-megawatt transactions. So anywhere in between, we're interested in deploying our capital in that manner. From a credit perspective, we don't have to have investment grade. Certainly investment grade is going to get your best terms and your best rate, but we'll do a couple notches below. We're basically roughly interested in anything equivalent to a BB minus, an S&P or Ba3 in Moody's, and better, which is a few notches below investment grade. So we've got some flexibility with respect to the credit quality. But really where we're seeing a lot of the growth, I mean, we've done a lot of solar and wind, and we're starting to do some CHP, but we see a lot of growth in distributed generation, generated assets, which includes CHP. So we hope to continue to see that growth, and we hope to be working with a lot of the people here in this room here. With that, I think we can turn it over and start a dialogue with some questions and answers. Thank you.
Okay, well, thank you. I think, why don't we just open the floor to questions. Just let us know who they're directed at, and if each person could identify themselves, that would be great.
Thank you very much. I'd like to ask a question. It comes up once in a while from the development side, and I think this it would be key to maybe get some of the private group some feedback on this. I'm curious on a large CHP project with a single source recipient of the energy. So again, you got a CHP project on a widget company, and they have the single source of all the energy. There's no exporting. What's your attitude, or what is your perspective? Are there any new rules changes when it comes to the off-balance sheet aspect of that? Do you provide that? What's the rules to it? And then on the secondary side of that, if you do that favorable, or again, the rules are favorable for it now, how do you feel about the OEM and where you come back to them as far as the guarantees of availability and performance on the machine, and how do you mitigate those risks?
Yeah, the rules are changing with off-balance sheet treatment, and I think the market's already adjusted to that, especially publicly traded companies or companies with audited financials. Any off-balance sheet transactions listed in their footnotes, and any creditor like ourselves or anybody that's analyzing a transaction is going to add that back in anyway. So off-balance sheet really isn't fooling anybody, I guess, or creating a true off-balance sheet. In the next few years, those rules are changing where everything's going to be on balance sheet. So essentially, the way we do that is we say, if you want an off-balance sheet lease or an operating lease, this is the way we set it up. It's up to your accounting staff or your accounting firm to decide whether or not that's off balance sheet, and then to work with the rules as they change. Now, with respect to the OEMs, and certainly we have an asset management group that looks to that piece of equipment to provide a residual for an operating lease. So we need to have high quality, like a Dresser-Rand, where our asset management group is going to say that equipment is going to be worth X percent at the end of 7 or 10 years. So that does come into play, but our primary focus is on the creditworthiness of that lessee. So we're looking at that company's balance sheet first, and then the equipment secondly, because that's going to be what we have our interest in, and then maybe third, the project economics.
I think you're completely right on leases. I think it's definitely driving to everything being off balance sheet. The alternative structure is a service contract that gets out of lease accounting. You have some very specific road markers to qualify for service agreement accounting, service contract accounting. And I think when you boil it all down, there has to be significant risk transfer away from the obligor, your full recourse party, to a third party, to a service provider. And I think what we've been able to do in the state and local sector is structure things so they are off credit. They may still be on balance sheet, but from a state and local bond issuer, what really matters is what S&P and Moody's says is their bond limit, their borrowing limit. With the structures that we've been doing, we announced a $25 million transaction with the City of Louisville that was characterized as a public-private partnership. There is significant risk transfer to the service providers to do what they said, and the obligor is not obligated to pay if they don't do what they do. That it's a more complicated structure, no doubt, but if you want to expand your ability or retain your ability to borrow, I think some of these service contract structures are worth exploring.
Thank you. Another question? If not, let me ask a question first. One of the issues we've paid a lot of attention to is what kind of projects do we fund? Do we fund only very, very low-risk projects where the technology is well accepted, like a wind or a solar project, or do we fund riskier new technologies? And riskier new technologies obviously create a different set of issues than funding a safe project. You've got a much higher risk of default. You know that some projects will default. So the question is, can you come up with a lending mechanism that works on that in our case? There are some banks that do that. The Silicon Valley Bank in California is funding risky projects. Venture capitalists obviously can put in the equity, but they would like debt financing on these projects too. So what we've said from the work I've been doing is we can do that. We just need a different business structure. A lending structure is more like a venture capital structure where you take interest in the business you're doing, where you get warrants or stock or something like that, so that when some companies fail, others don't. It's an important issue because if you look at Solyndra, which has obviously affected this field very significantly, and in a way it's affected it not just on the government level, because remember in Solyndra, the government lost money, but private equity also lost $1 billion in Solyndra. How do you fund projects like Solyndra where you know there are going to be some failures? I mean, and then others where, but you know that others will succeed.
First of all, I think make the distinction between Solyndra as a manufacturer and the manufacturing risks are fundamentally different than the project risks. I don't look at making big changes in greenhouse gas emissions sustainability as being needing that much new technology. The technology's out here. We've got the most efficient prime movers in the world represented. It's one part of technology problem and maybe 2 or 3 parts of finance problem. How you get to scalable finance structures. New technology should be funded with equity. And maybe it's the equity of a Siemens, a Schneider, or Johnson Controls, or a UTC. They're the ones who have that risk-bearing capacity to take that risk. It shouldn't be loans. I don't think those projects should be getting done with financing. They should be getting done with equity.
I think from a state perspective, unless you're talking about New York and California, there's rarely going to be the type of capital moving around where you can make a dent no matter how you structure it. So from a state perspective, I think that the focus is laser sharp on deployment of existing technologies for good reason, I think. The federal government obviously is in a different position. But speaking from the perspective of any state but our friends in New York and California, you're unless you pick one spot, you're not going to be able to move the needle all that much. So we view our jobs as driving deployment of existing technologies.
Okay. Any other questions?
Joe Camian from Van Zelm Engineers again. We see many project opportunities where there is risk involved. Owners don't want to take the risk, but the project is, fundamentally pretty sound project. Usually it's owners, large facilities, old buildings, no documentation, very clear that there's a project there, but the devil's going to be in the details. Is there a way of trying to quantify that risk and putting it into the financing model to let and some of these projects could be good-sized CHP installations, and as an engineer, it breaks your heart because you've got an owner who's unwilling to pay to do the necessary discovery to really draw a good box around the risk, but from a financing standpoint, it's an element of the deal. So just food for thought.
It makes me think of the Wärtsilä days when I was CFO, and the sales guys would come up with a project, and they said, this is a great project. And I said, yes, but it's in Guyana. And they said, yes, can you finance it? No. But there were other projects, say in Dominican Republic or Honduras, that were much more highly structured. In Honduras, we did an 80-megawatt plant, but the foreign currency was an issue. So what we did is we went to the free zones, sold them power directly, got the power, the utility laws changed so that was allowed, so that we had U.S. dollars to cover our U.S. dollar expenses. What strikes me is, in your question, is there's a gap between the engineering and the development and the financing, and the development's the key thing. And it's not easy. It's super hard stuff.
No, essentially, this is sort of to Alex's mission. There's hundreds of these opportunities out there. They're never going to get off the dime because you've got owners that are unwilling to spend a nickel, and yet they're giving away dollars.
I would suggest they're not going to go off the ground because you don't have developers willing to develop the project to the point where dollars can come in.
Correct.
And it's expensive capital to raise development capital, and it's risky, but that's the missing element in a lot of distributed generation.
Andres Jaramillo from Fifth Action. I have a quick question for Douglas. When you do the leasing, do you allow your assets to be offshore? And what are the conditions for that?
We do everything 50 U.S. states and Canada, so we don't have anything offshore.
That's offshore.
Yeah.
Okay. So then for Jeff, the question is, if you do the project and you're financing that project, the equipment belongs to a company that wants to sell the energy to the client, but it's going to be in the site of the client. Do you look at the credit rating or the creditworthiness of the client, or just the supplier of the electricity?
No, clearly we look at the credit rating of the off-taker. The one example where we didn't was in the Dominican Republic when we did 50-megawatt barges, and we made sure there were just two simple mooring lines. And they were U.S. flag vessel, and if they forgot to pay, which they did a lot, they're much better payer now, we would take it. And then they'd say, well, the Dominican Navy's going to attack. And we'd say, well, that's an act of piracy against the U.S., and we've got a bigger Navy, and they'd pay. So sometimes we knew we were able to generate power in the Dominican Republic, even if CDE didn't pay, that there was going to be some way, we were going to be able to, in a power-starved economy, make money. Those weren't the way the folks in Helsinki wanted us to set it up, however. We were calling some audibles after engines were shipped.
And that hasn't changed in the last few years?
No, it's a hard one to change.
Okay, any other questions? Okay, if not, I guess we can stop now. It's getting late. Thank you all very much. Appreciate it.